Hi, everybody. Welcome back to Cup of Joe. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. So 2 weeks ago, we saw stock indexes decidedly mixed. We saw a lot of that separation in asset classes that we've talked about a lot this year. But last week, things trended negative almost across the board as information on the US economy was published, primarily inflation, and as news out of Eastern Europe continued to develop. So here the stock market stands at, it has dipped into correction territory, which means that it has declined 10% from its peak, which was back on the very first trading day of the year, January 3rd. Much of the volatility we've seen in January and recently in February in the US is driven by inflation. Because inflation causes the Federal Reserve to raise interest rates, which is something that stock investors typically don't like. But right now, obviously, the major headline risk is tension with Russia's actions regarding Ukraine. Now, one thing I want to point out is that whenever there's a big headline risk like this, if this turns into a military conflict, we'll very likely see some short-term volatility pretty much in all markets. That's expected. But history shows us that this short-term volatility is usually just that, short-term. The market tends to look past these things much quicker than one might think. Back in 2014, when Russia invaded Crimea, the market barely registered it and continued on its trend that it was having at the time. And one extreme example that one of my colleagues pointed out is back in 2001, after September 11th, the market took a sharp turn, but had recovered within 1 month. So while this remains a decidedly major headline risk, the market tends to digest these things pretty quickly. Now, I was recently asked the question, well, what happens if the situation in Russia breaks out? The most direct effect is that this will primarily affect energy prices. Investment sectors dependent on energy are going to experience the most volatility. Russia is a major supplier of energy to most of Europe. But we believe that a more significant risk still remains the COVID variants. These have greater potential for more widespread economic impact than just a conflict in a relatively isolated region. But right now, all measures of COVID cases are heading in the right direction. So that's very encouraging. So while inflation is high, the US economy actually remains quite healthy. And equity markets were already at lofty valuations after a very strong 2021. So a pullback this year was not a big surprise, although the reasons it's manifesting itself continue to raise eyebrows. So while this is happening, we are actively rebalancing amidst the volatility, not trying to be market timers by any means, but just making sure that the allocations in your portfolios remain near the targets while the market experiences this repricing. So we're happy to answer any questions anytime you have them. Reach out to me or any one of the advisors, and we will be happy to talk about it. Have a great day.